Hello and welcome to episode 432 of the Money to the Masses podcast with your resident expert as usual, Damien Fay, and me, Andy Leeks. How are you doing?
Well, it's good to be back, Andy, because we missed a week. So you were unwell. You had your seasonal cold, as you were telling us. Actually, listeners are probably more aware of our seasonal colds that we get, because I do then tend to get one in the winter, because they listen to the podcast regularly and they probably get used to the odd episode that doesn't happen because we're sick or hear that we're unwell. But you were unwell last week, weren't you? So
yeah, I just had that seasonal thing. At the end of the summer, it tends to happen. Luckily, I got through the holiday without being ill, but straight after the holiday, as things, normally happen, you get back to the normal routine and
back to school, back to the germs, bring them home, and then you've got
chest
sick.
infection and the rest. But I'm feeling much, much better. So, sorry we weren't here last week. It's all my fault.
Yeah, so it's good to be back, and thank you to those who have sent in reviews. Please do send in reviews on the podcast, because we will read the best ones out, and you can potentially win a Money to the Masses mug. Now, we are going to quickly go back to somebody who we did mention on a previous podcast, because we got an email from them, and Andy, you're going to go through that email, because it's quite incredible, really.
It is, yeah. So Hazel, who we mentioned in the pod last week, and you'll remember who she was when I read out what she came back to us with. This was her response. I'll read it out. Damien and the team, I was so shocked when you mentioned my review on the podcast last week that I had to go back and listen to it again just to make sure. At the time, I was on a rough, lonely night shift sailing my small sailboat from Samoa to Tonga. The seas were 3.5 meters and very confused and uncomfortable, so the mention was a welcome distraction. I absolutely loved listening to the podcast since I found it some 5 years ago and have started investing any extra I've had, which isn't much because she likes to travel, quite clearly because of her boat. I just wanted to let you know that the work that you and your team do is invaluable and reaches and makes a difference to people all around the globe. So keep up the great work.
So that was a fantastic email to get, because it is nice to hear that we are making a difference, and we still got enthusiasm after 430 shows, which I marvel at sometimes, that we're still going strong after all this time. So if the podcast has made a difference to you, it is great and incredibly motivating to the team, because obviously when I got that email, the first thing I did was forward it to the rest of the team so they could see it and read how what we do at Money to the Masses does make an impact, because it can be very one directional. We broadcast things, we write content, we don't necessarily always get that feedback, so it's great if you can.
I just do need to prior warn you though that Hazel did go on to say that she's travelling to New Zealand next, where she's heading, so if we can either send the mug to her UK address or one of us can bring it out to her. So I won't be here for a month because I'm going to be travelling to deliver a mug personally.
So moving on with what's on this week's show, there are 3 pieces that we're going through this week, and you'll want to listen to all of them. Sometimes we have a slightly short one at the end, but they're going to be probably of equal measure this week, because I've got a piece I want to talk about inflation. So a bit of economics. I know that people are hoping when they're reading the headlines that inflation is going to fall. And we've even heard the Bank of England governor say as much, but I want to talk about what history tells us about inflation, and it won't necessarily it isn't necessarily good news. The other piece I want to talk about is money market funds and trying to get return on cash when you're investing in an ISA or SIP. And the last piece of the podcast this week, Andy, you're going to be talking about energy.
That's right. Energy prices again. The 1st of October is significant because that's the date where the energy price cap once again comes down. So I'm going to be doing a short piece on what that means for you, how much people could be saving, actually looking back to last winter and see how much we are saving compared to last winter as well, and looking at the question of whether people should consider fixing or not.
Yeah, and there are some significant changes to the way the numbers are calculated by the energy regulator when they talk about the average usage. So it means it makes it difficult to compare. You want to listen to that so you'll understand going forward what the changes mean. So I'm going to kick straight on then, Andy, with the inflation piece that we're doing this week. So if you've been listening to the news, you will have heard that inflation has officially fallen. So the official measure of inflation, which is the Consumer Prices Index, CPI, that fell from 6.8% in July to 6.7% in August. So that was good news. And what was good news about that was the market had anticipated it would actually rise slightly to 7.1%. So if you've been filling up your car lately, you will notice that petrol prices have been rising. So fuel prices have been going up. So that has contributed to an upward pressure on the official measure of inflation, but other things offset it. So the governor of the Bank of England also came out in recent weeks and said that the downward pressure on inflation was continuing and likely to continue into the end of the year, which is obviously good news. And you would have also probably heard that the Bank of England didn't raise interest rates this time around. So when they had their September meeting, they kept them on hold. And that was because of this surprise fall in inflation just days before that decision was made by the Monetary Policy Committee. So that was all good news. So people might be thinking, right, the cost of living crisis is about to disappear and things will get back to where they were perhaps before 2022. And if you look across to America, even their inflation figures have fallen more significantly than in the UK, actually. They've fallen to 3.6% as we make this podcast. So it seems like inflation's been conquered globally. And that obviously has been partly due to the central banks raising interest rates so aggressively, which has obviously caused tightening on the economy, particularly in the UK. And that obviously deters people from spending, which obviously then starts to bring down demand, which therefore starts putting downward pressure on prices. But not all of the inflationary pressures have been down purely to supply and demand. They have also been, well, in the UK, they've also been down to external factors. And this is one of the things that I want to go on to talk about in this particular episode, because the International Monetary Fund, the IMF, have just released a paper. And the paper was titled 100 Inflation Shocks, 7 Stylized Facts. And the key thing about the paper is they looked at 100 inflation shock episodes across 56 countries since the 1970s. And the paper was looking at how inflation behaved after these shocks, and that would be in response to the monetary policy decisions like hiking rates from different central banks around the world. Now, the paper's findings really underscore the persistence of inflation, and it's a word of warning to the central banks around the world, but also to us as consumers, because there is something called a term of trade shock. So terms of trade shocks are when you get a sudden change in the relative price of exports in a country relative to their imports. So that's an important thing to understand. And we've seen something like that. So an example could be if you get a sudden spike in the price of certain commodities. And the Bank of England earlier this year came out and said that what we're experiencing now in terms of inflation is a result of one of these terms of trade shocks. And if you think about it, energy prices, for example, have spiked. And so they're much higher, partly because of the Ukraine war, but there are other factors as well. We've also seen the oil price in the last 2 months rise 30%. So that is one of the reasons why you're noticing petrol prices are going up at the pump. So I filled my car up yesterday, and probably like lots of listeners out there, was actually shocked how much it cost me to fill up a full tank. So we've had one of these terms of trade shocks. And the reason why that is important as a definition, because the paper from the IMF actually found that in 60% of historical inflation episodes, shocks, that followed one of these terms of trade shocks, inflation was only brought back down within 5 years. And even in these successful cases, resolving inflation often took, on average, 3 years. So the takeaway from this part of the podcast is that just because inflation is seemingly falling, it doesn't mean we're not going to get a second shock, another wave of inflation, and it pick up again. Now, if you're looking at the news, you'll notice things like I said, petrol prices going up. So that is something that is obviously of concern. And we can look at particular episodes in history where we've had similar scenarios and inflation has picked up. So there were oil shocks in the 1970s, and lots of countries believed that they'd got inflation under control. So in the UK, for example, inflation fell back from 24% in 1975 to around 8% in 1978. And policymakers were what the IMF paper called prematurely celebrating the conquering of inflation. And the issue was that it then picked up again. And in 1980, inflation hit 18% again. And there are various factors why we saw that resurgence in inflation, and it included wage price spirals, global economic conditions had changed. But it was also because of a premature easing of monetary policy by central banks. So that played a significant role. And what that means is prematurely cutting interest rates. And so lots of people are hoping the Bank of England will cut interest rates. What the IMF paper actually underscored was the scenarios where inflation was generally conquered and we didn't get that second wave was when policy was kept tighter for longer. So they kept interest rates high. So if you fast forward to 2023, what that means is that if the Bank of England is going to conquer inflation that's been caused by one of these terms of trade shocks, then it's going to have to, if you base it upon history, it will increase its chances of success if it keeps interest rates higher for longer. So those hoping for interest rate cuts in the early part of next year, for example, that is less likely based upon the findings of this paper. Of course, we have to look at different scenarios. Every scenario is slightly different. I can't predict the future, but it's something that people might want to bear in mind. And there was a news piece actually I saw this week that was out there that started to cause a bit of murmurings in the mortgage market about the suggestion that we might have rates at the level for mortgages where they are now in 2 years' time. So when people come to remortgage in 2 years, things won't necessarily improve. Now, that is a bit of crystal ball gazing, but what we've seen in investment markets this week is a realization from bond markets in particular. Yields have gone up. It's something I'll talk about on the next episode of Damien's Market Update, which will be out in October. But this realization that actually we might have to have rates higher for longer. And banks have been hinting at it, but the market just wasn't listening. And so that's caused bond prices to fall. We've seen weakness in equity markets. I could go through other examples. There is another example after the 2008 financial crisis where we saw inflation pick up, then fall, but pick up again. Again, it was all in response to premature monetary policy easing. So the takeaway for this piece of the podcast is that be prepared that rates could stay higher for longer because inflation could come back. The cost of living crisis won't necessarily disappear as quickly as some people might hope. And even though the government is hoping to get inflation back below a target level, you see the headlines, and the Bank of England below its own official target of 2%, there is a very real chance that we could see another pickup in inflation.
Interesting stuff. So if people are interested in reading more about what the IMF has said there, we'll put a link to that paper in the podcast notes.
Yeah, it's not necessarily the easiest or most interesting reading, but if you do want to look at it, then like Andy says, we'll put it in the notes of this episode.
Okay, so let's move on to the next piece of the podcast then. Damien, you're going to be talking about money market funds. We haven't done this on the podcast before. What have we got?
So money market funds are an interesting beast. And just to give context where this came from. So we talked on the podcast a lot about the exciting rates you get from NS&I at the moment in fixed rate savings bonds. You even get it on the easy access account. So as the base rate in the UK has gone up, we've seen savings rates increase generally. I know there have been quite a bit of a lag from banks and building societies, but you can get a good return on cash now. The issue is that lots of people invest, and they may be investing via a SIP or an ISA, for example, not a cash ISA, I'm talking about stocks and shares ISA, and they may have money sitting in cash within that product, or they may want to disinvest for a period of time and sit in cash. I mean, it's their money, they can do as they wish. But one of the issues has been historically that these platforms didn't pay a return on cash, or if they did, it was very small, and that's starting to be rectified. So we've seen a movement whereby platforms are starting to not charge management fees on cash that's held. Some are obviously offering cash management accounts, so money can sit on deposit for a period of time, and they are also offering interest on that money, because previously what would happen is one of the reasons they wouldn't give you any interest on the money within a platform is because they could make money on that money. That would boost their profit margin, because if they didn't give you much interest but they could earn interest on customer deposits elsewhere, then that would boost their profit margins. But also the money held was generally deemed to be on its way to be invested, so it was only ever meant to be a temporary holding. But of course now with volatility in markets, but also the returns you can get on cash, then cash is starting to look more than just a temporary holding. It's also looking more attractive in terms of a portfolio diversifier, but also as a means of getting positive returns. So back on episode 406 of this podcast, we looked at the rates that are now being paid by some of the major investment platforms on cash that's held within their management account. So you could just keep cash and they would pay an interest rate. But that interest rate does vary depending on the platform and also the product, because they would pay often different rates for their ISA products and their SIP products, and they would also pay tiered rates. So depending on how much you put in, you'd get a different amount of interest. Now, Andy's done lots of analysis. I wouldn't say go back and listen to that episode. You can if you want an explanation of it, but the rates have changed so much, and he's just updated analysis for the latest rates. And you can find that on the Money to Masses website. We'll put a link in the notes of this episode. And there are some quite attractive rates. Bearing in mind it's easy access, there are some quite attractive rates out there. There are some still miserly rates, but you could, if you wanted, pick a platform that does pay a decent rate on cash. Now, I'll just throw one or two for people who are listening to the podcast. Bestinvest is by far the best payer on cash. They actually, at the moment, as we do this, pay 4.35%. When you compare that to some of the worst on ISAs, for example, so you've got stocks and shares at ISA with iWeb, they don't pay anything, but they do on their SIP. So there is a range of interest rates. So when I'm looking at this now, as I'm doing the podcast, I would say the average is somewhere between probably 2.5% on a ISA and then about 3% on a SIP. So you can get return on cash that's just held on deposit with the platforms. But I just want to quickly answer one question. Some people might think, well, why don't they give you, for example, access to fixed rate savings bonds within SIPs? And the reason that has come to light, or the reason that's given for them not being able to, is that they are classed as non-standard assets under regulation. The platforms class them as that if they have more than a 30-day fixed term. So you can't get your money back within 30 days. And because of that, the platforms are obliged to hold higher reserves to safeguard clients' money. And so the platforms make a decision they're not going to offer those products. Some platforms you'll find might offer them, but most don't. So that's why you can't get a decent fixed term product like an NS&I bond that I got so excited about the other week inside of a SIP, for example. But this piece that I'm doing is being inspired by an 80/20 investor research article that I published this week. You can go and get a free trial if you're not a member and read all the details. But aside from getting a return on cash you might get on deposit with your platform, you could look at gilts. So we covered that in podcast 423. Do go back and listen to that episode because it's particularly interesting for high rate taxpayers, because short-term gilts are now offering a good return, which can mostly be tax-free. So even if they're not held within a SIP or an ISA, high rate taxpayers can get over 5%. And that is after tax. And that's because you hold them and they're backed by government. And if you hold them for a short period of time, within, say, a year, you get your small interest payments, but also you get the maturity value back. They can be a good way of getting a return on cash, but go back and listen to that particular podcast episode for more information. One thing I would say is that platforms are offering the ability to invest directly into individual gilts because of this fact. They're gaining popularity. So people at Hargreaves are making it easier to invest in them, for example. But this all gives you the lead up as to why money market funds are now become interesting, because you could have a platform that pays you a miserly level of interest. And you may not have access to cash at all. You might be in a product that doesn't give you that. And so you might sit there and think, what other things can I do that can give me a return on cash? So that is where money market funds come in. And in the US, just as a side note, we've seen money be taken out of regional banks. So they've regional banks in America and being put into money market funds that are now giving decent returns. And that's what caused the mini banking crisis we had. It wasn't really a crisis, but it started to look like it might be one earlier this year. So money market funds globally are becoming interesting because central banks have increased interest rates. So what is a money market fund? Now, a money market fund is a form of a collective investment. So you can think of something like a unit trust or an OEIC. And what they do is they invest in short-term debt instruments, things like treasury bills, commercial paper, certificates of deposit, in order to generate a return. Now, you will see if you look on most platforms, there might be a cash fund. But the important thing you've got to understand, which is one of the reasons I've never really talked about them in the past, is that it's not cash. It's not the same as money in a bank, because there is an element of investment risk in them. So just to give an explanation of the pros and cons, they do offer liquidity, because if you think about it, if you put your money in one of these money market funds, you can then withdraw it again. So there's not like a fixed term deposit. Now, over the last year, the rate or the return you're getting on these funds has increased. If you look at a chart, it's gone up, and you could get, say, 4% on one of these funds over the last year. And that includes a period where rates have been increasing. So if rates stay higher for longer, the amount you're going to get on that money market fund is going to be even higher, probably about 4 or 5%. It depends on the individual fund. They are obviously meant to be low risk, and when you compare them to normal bonds, they're lower risk than normal bonds, and they can be competitive in terms of cash-like returns. They are sensitive to interest rates, though. So this is one of the cons. So if interest rates change, the return you get on that money market fund can change significantly. And there is an element of credit risk because there are financial instruments they're investing in that are going to give cash-like returns. But you also got market conditions can cause problems. So like I said about interest rates and interest rate expectations, but if you get a flood of money in to a cash fund, and then you get a flood of money out, they've got to try and meet those redemptions, then that can mean that they can struggle to do that. Actually, the FCA published a paper on what happened around March 2020. So when you think back to the pandemic, there was a lot of strain in investment markets. And as part of this research, I produced a chart for 80/20 investor members that showed the money market funds that were losing money during that period. Okay, we're not talking about significant amounts, but the value of them was falling by, say, 0.2, 0.3%. And if you look at the number of periods in terms of weeks where they were finishing in negative territory for that week, then sometimes it can be quite significant over a 2-3 year period. You could be talking about double figures in some instances. So the message is, unlike cash in a bank, your value of your money market fund can fall. So bear that in mind. And in the past, when we got to the financial crisis, obviously many years ago, there was some quite high profile cases where investors felt they were misled about what actually occurred in these funds. And therefore they thought they had cash, but the value fell. And then when they obviously redeemed their money, they had less than they put in. Bear that in mind. So with those caveats out of the way, money market funds now represent an opportunity for investors who are looking for a cash-like return, knowing the risks. So under the terms of the Financial Services Compensation Scheme, you are protected up to £85,000 per firm, per person. So if you had money in one of these funds, it would be covered under the Financial Services Compensation Scheme if it were to go bust, there was something to go wrong. But if you're looking at these funds, there aren't many options. So when you look at them, don't just focus on the return. Look at the annualized volatilities. That will give you a view of how they're behaving. Do look at the number of periods where if you can find this information, you can't necessarily readily find it, but if you can see the number of periods where they produce a negative return, do focus on the periods of strain. So go back to 2020 when markets were under significant strain. Look at any funds you're going to consider to invest in and see how they behaved around those points. I would suggest that because money's going into these funds, then the risks in terms of a rush of redemptions increases, because obviously if there's more money in there, then if there's suddenly a big pull out, then maybe you could say the risks are increasing, maybe of there being an issue in the future, but you can't say that for certain, but just bear that in mind. But I suppose the question people want to know is, what sort of return have these things produced? If you look at their last year returns, that takes into account the period where rates are going up. So we haven't had where the base rate is now. We've had a significant series of rate rises. The 1 year return I'm looking at here, the highest is about 4.3% you would have got over that year. The lowest is about 3.5%, which, given that some of the rates that we're seeing on what platforms pay on cash, that would be of interest to people. If you look at the annualized return over, say, 3, 5, 10 years, then obviously those numbers are pretty low. They're often below 1 because that was a period that included historic low interest rates throughout the market. And one thing to bear in mind, the numbers I've quoted are net of fees, because these money market funds do charge annual management charges. They are, of course, relatively small, maybe something like 0.15% you'll see on most of them, something like that. So in summary, there are other options if you are looking for cash-like returns beyond just money on deposit. Money market funds are interesting. They do come with risks. Make sure you are aware of those risks before you put your money into them, or when you're doing your research. And the risks include credit risk, interest rate risk, and liquidity risk.
So you mentioned there about what people need to look out for in terms of when they're researching these money market funds, but you've done the research on 80/20, that's right, isn't it? So if you want to get hold of that data, you could sign up for a free trial.
Yeah, that's right. So I've done that for 80/20 investor members. So if you're interested, you can go and look at that and you can read about it in much more detail.
Okay, so let's finish off the final piece of the podcast then. We're going to be talking about energy again, and a significant date has just passed, the 1st of October. It's a date where, firstly, we should remind listeners, if they haven't already, to make sure they do their meter readings and submit them. And the reason being is the energy price cap has changed once again. So energy prices have fallen slightly by around about 7%, and that's the reason we're bringing it to the pod today.
Yeah, and of course, if you are a smart meter owner, so you have a smart meter, then technically you won't need to do a meter reading because it should be uploaded automatically. But if you don't have smart meters, which there are a lot of people out there that don't, then it is worth taking a meter reading, gas and electricity, and submitting that to your supplier.
So the energy price cap is the cap that's set by Ofgem, which is the energy regulator. And if listeners remember, we've previously had the energy price guarantee, which was set by the government. And that was a cap that they put in place to ensure that people didn't pay any more for their energy than $2,500. Now that's actually gone up to £3,000. Let's just park that though, because that's no longer really a conversation we need to have, because there's the energy price cap that we need to talk about, which is the figure set by Ofgem. So as of the 1st of July, that figure was £2,074, and that's for the average UK annual usage. That's dual fuel energy. So we're talking about electricity and gas. That has actually come down now as from the 1st of October from £2,074 for the average family to £1,923. So there's a 7% drop. So we are seeing energy prices coming down.
So that's good news that we're seeing the direction of travel. So like you said, almost forget the energy price guarantee from the government because that's way higher. But we look now working on the energy price cap, which most people will be on because they'll be on the standard tariffs. That's progressively coming down, like you said, at the point we had in July. Now we're having in October. So there has been a change, because one thing to bear in mind is the numbers that we talk about and the regulator talks about is about average energy usage. So somebody, if you quote the number of what the average energy usage for the energy price cap, like from October, is £1,923, that isn't what you pay. It's based upon what you use, because the cap actually is based upon the price per kilowatt hour for the energy itself.
That's it. It's ever so confusing. Like you say, you alluded to there, it's actually slightly more confusing than that. So let's just cover that off now. Ofgem, in their infinite wisdom, have produced some new figures. Basically, they've looked at the annual consumption for average UK households, and it's actually slightly less than they were saying it was a year ago. Whether that's because people are actually using less because they're aware of how much energy costs, but those numbers have come down slightly. So Ofgem have redone the numbers ultimately.
So what you're saying is their average usage amount is now, they're saying, is lower for a typical household. So the number you're hearing quoted for the typical household, the typical annual energy bill, yes, it's going to have come down because energy prices have come down, but it's also coming down because the figures that Ofgem used to say that's the amount that an average household used is now lower as well, which really, in my view, I think muddies the water quite a bit, because you're not really comparing apples with apples, are you?
That's right. So it was 1,923, which is the figure I said earlier. The actual figure now from the 1st of October, because they're adjusting these numbers, is 1,834. It's arbitrary, really, because energy prices haven't come down anymore. They've just adjusted what they consider average usage.
Yeah. And can I just say one thing? I've drawn this analogy before, and one of the issues we've got in the UK is the way we talk about energy. So if we talk about filling up our car, we know how much it costs to fill a tank up, but people focus on the pence per litre, and they shop around, or they'll talk about, I had to pay X amount pence per litre to fill up the car. And the issue with the energy market is that the price cap relates to the kilowatt hour. So it would be, if it was a car, it would be the pence per litre. That's what's being capped. But we're always talking about like the equivalent of, well, how much does it cost to fill up your tank, or the typical tank? And we've got into this world, this conversation of talking about these average numbers for a household, and they don't really mean anything, because it's what you pay individually because of your own usage. It's a bit like me and Andy when he comes in and he says, I had to pay X amount to fill up the car. Well, Andy's car is very different to my car and what we use it for and everything like that. And so they're not comparable when I say it cost me 70 quid to fill up my car and it cost Andy 80 quid, because they're different cars. So that is a problem with this, I think, the way we talk about energy with the regulator, but it is what people do. So
it is what it is. It's difficult because there are regional variances as well, what people pay in certain regions, and that's why they try to keep it simple using these average numbers. What I'd like to talk about today is actually, let's look back to last winter. We've said there 17% since July it's come down, and then 1st of October it's another 7%. But what does that actually mean, pounds and pence, when we compare it to last year? Because we know we were all struggling last year, and that's why we had the government's energy price guarantee. So last winter, everyone was being capped. I say everyone that wasn't fixed was being capped at £2,500 average usage. What we're seeing now is we're seeing a figure of about 1,923. Again, assuming people haven't fixed and they're being capped. So that's around about a 25% saving when compared to this time last year. So if you use numbers, if you were used to paying £300 per month last winter, we're going to be looking at around about £225 per month now. That's a saving of about £75 a month using those numbers. Obviously, your figures will be different. You can do the same maths and work out what 25% means to you.
Yeah, and that's probably one of the big takeaways. So when we talked about this before the podcast, it was a key thing saying this is quite confusing. People's heads, they know what they were paying per month for their energy. Broadly speaking, because people will pay the same amount every month if they're on the tariff where they'll be paying, spreading the cost across the year, then roughly speaking, it looks like we'll be paying 25% less than we paid last winter. So that's good news. And actually, because this is based upon predictions from Cornwall Insight, they're always doing the predictions. Their predictions are spookily accurate, because I think I recall when we did something on energy much earlier in the year, this was kind of the ballpark we were talking about, that 20%. So do the maths when you finish listening to the podcast, then you know roughly where you're going to be in terms of energy costs this year. And to keep things simple, we haven't included the energy grant in these numbers, which, if you remember, was the £400 that the government gave out, which ultimately meant households got a credit of around £66 a month on their energy bills between October 2022 and March 2023.
So the next thing I really wanted to discuss was whether it's worth fixing, because that's what everyone's asking. What I would say is 1st of October is that key date where energy prices are coming down. We are going to see new tariffs entering the market quite regularly now. And actually at Money to the Masses, we're committed to doing reviews of the best tariffs that we want to put out there and really educate people on saying, is it worth considering this one? Now, again, you've got to remember all the different moving parts. And some of this does include those future predictions that actually no one knows. So there's an element of crystal ball gazing here. Most deals at the moment are only available on a 12-month fix. So you're actually only going to be fixing for one winter. But when you consider that we already know what the energy price cap is from October to December, we don't quite know what's happened in January yet, but we've got a good idea through Cornwall Insight. What are you actually paying for there? What are you fixing? One winter. Is it worth it? It's up to you. If you value knowing exactly what you're going to be paying, then it may well be worth fixing. But you need to remember that you're fixing into something that you don't yet know what the future price will be. So you could end up paying more, and you've got to consider that some of these tariffs will have exit fees.
Yeah, so it's the certainty. Some people may be at the point when they're looking at their money and they're worried about if prices go back up again, whether they'd be able to cope. They may want the certainty in saying that their budgets can cope with energy levels at the new prices that we've been quoting there. They can cope with that, and they might want to fix. That's about certainty. It doesn't mean that energy prices won't get cheaper. And as you say, you've got to be mindful of exit fees, because exit fees on any tariffs we're seeing, they're higher than what we saw pre-2022, when you'd get a tariff would have about a £50-60 exit fee. They're now twice that.
Yeah, you could be, I've seen exit fees £120, £200 for dual fuel. So just be aware of that. So, I mean, look, if you can save 5 or 10% on what is the new energy price cap, then that's a decision you need to make. But just be mindful that energy prices do change. We don't know what they're going to be in the future.
And as you mentioned, we're going to be on the energy tariffs that are coming out. We're going to be doing reviews about them as they come. So make sure you watch the YouTube channel, read our articles, listen to the podcast, because we'll be talking about them all the time. But at the moment, just to give a quick overview, what are we sort of seeing in terms of tariffs? So we're seeing new things come to market. What are they? Are they fixes? Are they sort of relation to the energy price cap?
Yeah, we've got a couple of fixes that have come out that are around about 8% less than the July cap, but actually they're slightly more expensive than the October cap. But actually, when you're looking around, it may be worth considering fixing. Again, we don't know what's going to happen in January and beyond next year. There is a tariff from E.ON Next, which isn't a fixed tariff. It is a tracker tariff, but it pledges that it will guarantee to stay 3% less than whatever the price cap is as it moves. Obviously, that may be a consideration for some people. There is an exit fee on that, £50 for dual fuel.
But is that only available to existing customers of E.ON?
Yeah, what we're seeing with a lot of these deals that are coming out, it's often only available to existing customers. Whether they broaden that out to new and existing, we don't yet know. But yeah, existing customers only.
Yeah, and my view is, just as somebody who looks a lot into all these things, I think what we're going to see is some preemptive moves by energy companies to try and keep customers with deals like this, because you've got to think, once we start getting the energy market opening up again, and if you get deals, people will start switching, and they will switch probably en masse, which will be problematic for the industry to cope with the volume of people that want to switch. But this can also be seen as a bit of a defensive maneuver. If they're giving a small discount, then people will be like, why would I switch? I'd rather lock into this tariff, and they know they've got those customers for another year. And it's for the companies themselves, it's obviously easier to plan. So I think that was a great piece, Andy. I think it's given a lot of insight into what's going on in the energy market, because things are changing. The piece you said about the changes to the Ofgem cap, how it's worked out, I don't even think that's been widely spoken about. So it allows people to understand where we are at the market now. We're still at the point where the energy price cap is still really where most people will stay, and they will be probably better off staying on for the time being at least. But these things will change in the coming months.
So that's it. We're done for this week. If you want to get in touch with Damien, you can do so in the usual way. It's Damien@moneytothemasses.com. My email address is Andy@moneytothemasses.com. If you've got any feedback or ideas for future shows, we'd love to hear it. Don't forget, we've also got the community group here at Money to the Masses. Go to facebook.com/groups/Money to the Masses to get involved with that. And of course, please do feedback on the show. If you can give us a 5-star review, it really helps us spread the word and rise up those charts.
Yeah, and as ever, do follow us on all the other social channels, and of course, subscribe to our YouTube channel as well. So all there is left to do, Andy, until next time.
Until next time.